take us through this week, because it was wild. We forget that at the beginning of the week, we had the NASDAQ going crazy. Tech was really big. Then tech sold off, went to cyclicals. End of the week, sort of risk off. What's going on?
Yeah, so it's been a crazy week and really also quite a year in equity markets. When you look at the numbers year to date, markets are actually only up 0.5%, the S&P 500. But of course, under that, we've got the median stock down 19%, the FANGs, which you alluded to, up 35%, the other 495 stocks down 5%, and growth in value at this record spread of 30%, although that's narrowing. A couple of points I want to make here is that we do need some things to support equity markets at these levels, because valuations are quite expensive. They're at a 22 times 12-month forward price to earnings, which is in its 95th percentile most expensive. And so we need to see the fiscal support that you alluded to and continued monetary support. And then from an earnings perspective, the expectations are low, but we're going to need these companies to come out and beat those low expectations. So earnings are definitely something to watch for the rest of the month and the rest of the summer.
So, Katie, we're sort of in the middle of the earnings season right now. What have we learned so far? Because some people certainly have beaten those lower expectations. Other people have disappointed.
Yeah, that's right. And so let's just define low expectations, because they are quite low. Expectations were for a 43% year-over-year decline. That's the lowest that we would have since 2008 in the fourth quarter, where we had a 70% year-over-year decline. So again, expectations starting low. The current state of things is we've had about 25% of the U.S. market report in terms of number of companies, about 30% in terms of market cap. 80% of those companies have actually outperformed, or they've surprised on the upside. Three, if I could, David, maybe I'll pull out three quick trends that we're seeing across all of this. The first trend I would say is this growth value dynamic. So you have these tech companies that had very elevated expectations, and they're actually coming in a little light, and that's causing many of them to sell off. And then on the other side, you're actually having some of these cyclical companies, industrials, beating some of those low expectations and getting a lift from the market. And that's caused the growth value dynamic to really narrow by about 7 or 8% over the last couple of weeks. Second dynamic I'd point out really quickly is that we are not seeing typical recessionary behavior. And a great example of that would be home builders. Usually in a recession, people delay buying homes, but Lennar, a U.S. home builder, came out with a 9% increase year over year on profits. Now, why is that happening? Because in the COVID recession, we have these record low rates translated into record low 30-year fixed rates. We have a lot of people trying to move from urban centers to the suburbs, and that has caused pent-up demand to be realized, and home building stocks going up in a recession, which is very unusual. And then the third point I want to make is how important it is to be specific company by company. Even in very narrow parts of the market, we're getting a lot of differentiation. So I'll end briefly on restaurants. We've liked restaurants because we know millennials like experiences over things for a while. And in particular, we like restaurants that are affordable, convenient through digitalization and delivery. So you've got a company like Domino's, 75% is done through digital delivery. And they've actually reported same-store sales up 16% year over year, stocks up 30%. On the other side of the spectrum, in the same category of restaurants, you have something like Darden, which owns a bunch of brands where it's more likely for one to do dine-in rather than delivery. And they're showing same-store sales down 40% and the stock's off 30%. So it just gives you a sense of even within sectors, you have to really discriminate across these business models.
So, Katie, a lot of us have been pretty absorbed with what's going on in the United States this week, but there was this little event at the beginning of the week over in Europe where they got together on a massive fiscal package, surprised everyone. Does that make you more optimistic about Europe?
This is great news for Europe. It really is. It's a $750 billion rescue package for Europe. The first time that all of the EU member states have come together collectively and issued debt. This has very big impact longer term for how they can cooperate together. Super bullish for the long-term cohesiveness of Europe, which we'll all remember has been at question at times over the years. Also very bullish for European assets, bonds, the euro, and European equity markets. And just taking a step step back, when we look at European equity markets, we do selectively like parts of that market. Let's call out a few things. The first is that the European recovery is well on its way. They were very strict on the lockdown, but they're doing better on the recovery. PMIs were released this week, 55 for the euro area. It was 48 in June, so we're seeing signs of that expansion. Second point I would make for equity markets in Europe is valuations are at a 22% discount to the US, despite that better growth trajectory. And so that's obviously compelling. And then the third point I want to make is Europe's leadership on green technology. That's about a third of that $750 billion rescue package is going to be pointed to a green recovery. Europe is going to be a leader in sustainability. And so while the US is going to continue to dominate, in our view, traditional tech and biotech, Europe has a real chance to lead here on the green technology front. And we like companies in that space. So an example of that would be Neste, which is the global leader. They have 65% of the renewable fuel market. Europe has committed to being carbon neutral by 2050. They're going to be a big winner in that. And in fact, they came out with this, or their earnings this week, EBIT up 30%, stock up itself about 15-20%. And so that's pretty good for an energy company in 2020.
Katie, just to wrap up this survey, China. There were some developments with China and U.S.-Chinese relations. Did the markets pay any attention to that at all?
It's hard to tell because there's so much going on, but I mean, obviously we had a lot of volatility this week. And so I think some of that tension was baked into the volatility. And, this is a serious issue. This is the world's second largest economy, and it would be good for the U.S. to have a constructive relationship, the business community, with the world's second largest economy, particularly when we're in the midst of a recession. But I will say that our CEOs are expressing some pessimism on this relationship, regardless of who wins the White House. And I think this is something we all need to watch over the coming months, and certainly hope that both of these superpowers can get onto a trajectory of a constructive relationship, which would obviously benefit both economies and both countries. So we can hope for that,
Right.
but clearly the signs this week were disappointing on that front.
Yeah, really important point about no matter who's in the White House, because basically right now, Democrats and Republicans both agree on one thing: they don't like China very much.
We do have agreement on that point. That's the one thing for sure.
Yeah. So we have to be careful where we look for our bipartisanship, and indeed, because we're going to have to be dealing with China for some time to come. As Katie says, they're the two largest economies in the world. They have to deal with each other somehow, right, Katie?
That's right. And I would say, just end it by saying that I do think emerging markets still is a good place for clients to look for growth and diversification outside of the U.S. And so that should certainly be part of people's portfolio, but they need to be aware of that risk, which is going to impact both the U.S. as well as China and the emerging markets.